Hello, friends. Welcome to our weekly podcast. This week with us, we have Ms. Tanvi Kanchan, who is the Vice President and Head of Strategy at Anand Rathi Group. Hi, Tanvi. What exactly is an active or a passive investment philosophy in mutual funds?
Hi Karthik, thanks for having me on the podcast again. So, the idea or the philosophy behind investment is to beat a certain benchmark, for example, inflation, and in order to create an alpha over and above the said benchmark. Passive funds are those that are designed to track the index by investing in the same stock as the index. So, for instance, if a Nifty 50 based index fund, it'll have the holdings and the weights exactly similar to the composition of that of Nifty 50. For instance, taking Nifty 50, the top 10 stocks within the index has approximately a 57.74 weight as on 3rd of August 2021 out of the total 50 stock that it holds. So here, the performance of the index fund tracking the Nifty will also have this particular skewness in its holding and thus having a very direct impact on its return. Whereas in case of an active fund, the fund manager has the autonomy to pick stocks which will help him to give the best possible return and at the same time manage the risk or the downside. By this logic, we usually believe that the active funds would be able to outperform the index or the passive funds. However, this isn't the case at all the time.
How does active investing fit into the goals or financial strategies of investors?
So, over the last 10 years, on an average, 80% of the open ended, actively managed, diversified Indian equity mutual funds have generated an alpha, with the exception in the year 2018 and 19, where only 2% and 22% respectively of the universe delivered an alpha. So, why did this happen? There were three major cases for that. The movement in Nifty had been concentrated. The top five that had a weight of 30% in Nifty contributed to over 214% of the Nifty returns in 2018 and about 100% in 2019. Whereas in the previous years, these funds contributed to an average of only about 63%. This shows that 2018 and 19 were a year of concentrated rally, not seen in any of the previous years before. So, if any active fund manager had an exposure of less than 37% of allocation into these stocks, they witnessed a negative alpha. Then we also saw mid caps underperform to large cap, which were at 12-year high. SEBI also released a mandate to recategorize mutual fund, which was a one-time activity and which resulted in a high churn ratio in some of the funds in order to meet this regulatory requirement. However, as time period increases and the markets go through various cycles, they provide alpha generating opportunities to fund manager. Underperformance for a short period of time should not be used to make long-term investment decisions or undermine the importance of a streamlined investment approach followed by active fund managers.
How is it that active funds outperform their passively managed counterparts?
Investment decision in a mutual fund solely depends on your risk preference and investment goal. Index funds are ideal for investors who are usually risk averse and want returns in the same line as that of the benchmark. These funds will give you returns matching the upside and the downside of the benchmark that it is usually tracking. Investors should look at the investment decision basis their objective. It is their objective combined with the risk taking abilities and the time horizon that should be the basis of their financial strategy and their investment approach. So, for instance, assuming an investor with a moderately aggressive risk-taking capabilities, they would be able to generate an alpha of somewhere around 11.7% vis-a-vis Nifty in the last 1 year. That is an absolute return of 54.3% had they invested in our well-researched, actively managed model portfolio. Thus, an investor needs to look at good recommended funds and not keep their biases towards active or passive funds basis their investment need and risk profile. Investment strategy alone should be the driving factor for an investor.
Thank you, Tanvi. So, friends, that's it for this week. Don't forget to tune in next week for yet another podcast. Thank you.